This week on Islamic Markets Briefing, we will cover a number of key global Sukuk issuances, the growth of the Islamic Financial Services Industry in 2020, Qatar's Islamic FinTech market, and the Egyptian Islamic Banking Market 2021 volume. On Expert Talks, we'll be hearing from Arshad Mohamed Ismail, CEO at Bank Pembangunan Malaysia Berhad, on the role of development finance institutions in economic development. Tanzania has witnessed the issuance of its inaugural Sukuk offering, which received high demand from investors. The Sukuk, amounting to 2 billion Tanzania shillings, was offered by Tanzania-based Islamic finance company Iman Finance by way of private placement. The Sukuk was oversubscribed by 36% and raised 2.72 billion Tanzania shillings in bids. Saudi Arabia's National Debt Management Center, NDMC, has concluded its August 2021 issuance under the government of Saudi Arabia's Saudi Riyal-dominated Sukuk program. The size of the issuance was set at Saudi Riyal 11.358 billion, according to a statement issued by the NDMC on the 18th of August 2021. Mohamed, the Minister of Finance of Egypt, states that the country is prepared to issue the first Islamic Sukuk issuance for the second half of the fiscal year of 2021-2022. The value of the Sukuk that is expected to be issued amounts to $2 billion. The issuance of the Sukuk will provide the required funds for investment projects, which are part of the Economic and Social Development Plan under the budget of the state for the fiscal year of 2021-2022. The Islamic Financial Services Board reported that the Islamic financial services industry was worth an estimated $2.7 trillion in 2020, reflecting 10.7% year-on-year growth. This was published in the IFSI Stability Report 2021 on the 18th of August 2021. IFSI's performance comes about despite uncertainties caused by the COVID-19 pandemic and was led by solid improvement across three of IFSI's segments, including Islamic banking and the Islamic capital market. The Islamic banking segment retained its dominance in the global IFSI in 2020 with a market share of 68.2% at the end of the third quarter of 2020. The other sectors like the Islamic capital market and Islamic funds too recorded significant values of growth that contributed to positive performance by the IFSI in 2020. The Islamic FinTech market in Qatar, one of the GCC region's FinTech hubs, is forecasted to grow at a compound annual growth rate of 19.6% from $849 million at the end of 2020 to $2 billion by 2025. Qatar has been ranked among the top 10 countries in the Global Islamic FinTech Index. This was according to Qatar FinTech Summit, which took place in Doha on the 24th of August 2021, hosted a gathering of C-suite executives, leading industry experts, policymakers, and government officials from all over the world, and was aimed at discussing the future of FinTech considering current challenges as well as business opportunities and market strategies. The Egyptian Islamic banking market reached 390 billion Egyptian pounds in terms of volume in June 2021, amounting to 5.1% of the Egyptian banking market, according to the Egyptian Association for Islamic Finance. Many Islamic banking products have been developed by the Egyptian banking market, aiming to meet the requirements of customers. More of such products and services are required in the form of Sharia-compliant products, both for individuals and corporate customers. Faisal Islamic Bank of Egypt contributed 31.5% of the Islamic banking volume in the country, with Bank Misr Islamic branches and Abu Dhabi Islamic Bank Egypt ranking second, 21.7% and third, 20% respectively. Incorporated in 1973, Bank Pembangunan Malaysia Berhad, BPMB is one of Malaysia's pioneer state-owned development financial institutions. Over the years, BPMB has continued to support Malaysia's infrastructural solutions and was authorized to issue medium to long-term financing to the nation's nascent infrastructure, maritime, oil and gas, and technology sectors.
That was very much in line with the aspirations of the government to see growth in these so-called mandated sectors from the perspective of BPMB. In 2019, we took a critical look at our role and we took a critical look at our focus areas. And it was in 2019 that we decided to become sector agnostic. However, becoming sector agnostic did not mean that we were going to stop supporting the four mandated sectors that we had been supporting for many years. Despite being sector agnostic, we continue to fund many infrastructure projects because that is still a developmental need in Malaysia. We continue to support the oil and gas sector, despite the challenges we have seen in the oil and gas sector as a development finance institution, and taking into account the developmental priority of the country. We have been and continue to support the oil and gas sector. And maritime and technology, we definitely continue to support these sectors as well. But the point is that by becoming sector agnostic, we are now able to look beyond these four sectors. For example, we are able to support food security projects because we see that as important for the future of the country. But the sort of a main theme here is for us to understand the impact of the projects we propose to finance. So historically, we have been playing the role of financier, and there has been some criticism leveled against Bank Pembangunan in terms of the bank behaving too much like a commercial bank. And this was one of the criticisms that drove us to take a critical look at our operating model back in 2019 that led us to go down the sector agnostic path. But as part of the evolution of the bank, we realized that understanding the impact of the projects we propose to finance is very much at the core of what a development finance institution is expected to be focusing on. And that is something we have put in place with the help of partners. And we have been running this framework that helps us understand the impact of projects we propose to finance.
BPMB, seeing the broader trend and development of the Malaysian economy, is looking to fully convert to an Islamic development financial institution and tap into the benefits this will bring. The bank has undertaken to offer a range of Islamic financial facilities that consist of and are not limited to fixed assets, fixed working capital, revolving working capital, trade facilities, leasing and industrial hire purchase.
We do have some legacy exposures that are conventional in nature, and we have been actively converting many of these conventional exposures to Sharia compliant financing structures. However, there is still a small percentage of our exposure that remains in conventional form. On liabilities as well, we have been actively working on converting many of our conventional liabilities to Sharia compliant liabilities. So in summary, the exercise remains work in progress, and despite the time it is taking for us to become a full-fledged Islamic development finance institution, the commitment remains. And once we can confirm that the portfolio is 100% Sharia compliant, we will at that point in time be able to declare ourselves to be a Sharia compliant development finance institution.
Malaysia's banking sector has struggled to cope with the drastic economic impacts of COVID-19 since its outbreak in 2020. Banks are facing higher delinquency rates, leading to higher non-performing loans as customers are more vulnerable to disruption from COVID-19. In order to tackle this, the Malaysian banking sector has introduced relief measures like allowing for deferment of payment for up to 6 months or longer. 2021 also saw blanket loan repayment moratoriums introduced by the banking sector for 6 months, April to September 2021, to businesses in order to ease cash flow. With businesses now opening in a phased manner due to the ease of lockdown restrictions in Malaysia, a rise in overall spending will support the economic recovery.
As a DFI, we have to understand which sectors the government wants to see supported. And that has always been our philosophy as the Development Bank of Malaysia. And the evolution of our focus is in line with the specific focus areas of the government over the years. But going forward, we will be focusing a lot on sustainability. And that is already very much at the core of how we operate, in addition to our aspirations to become a full-fledged Islamic DFI. And in addition to our focus on sustainability, digitalization and technology will also be key drivers as we move forward as a DFI.
The adoption of a holistic approach to business management that considers economic, environmental, and social risks and opportunities alongside financial factors has been heavily fueled by the UN Sustainable Development Goals, the recommendations of the Task Force on Climate-Related Financial Disclosures, and other initiatives. This is seen as part of measures taken to generate long-term benefits for the sake of business continuity and value generation.
It's one thing to speak about impact financing, but we must have an objective way to measure the impact of projects we are proposing to finance. And I think this will be a good time for me to talk about how we have put in place a framework that helps us to objectively evaluate the impact of projects we propose to finance. In 2019, we roped in the World Bank to help us develop an impact assessment framework. Internally, it is known as the MIND framework, measuring impact on national development. One of the first questions we had to answer was what it is that we want to measure from an impact perspective. So when we started work on developing the impact assessment framework, we decided to anchor the framework to the UN SDGs. The first question was, which of the 17 UN SDGs would we want to focus on? We looked at our portfolio as it was then and mapped the portfolio against all 17 SDGs. And we realized that 5 of the 17 SDGs were most relevant to our portfolio at that point in time. And to name them, these are UN SDGs 7, 8, 9, 10, and 13. And over a period of 6 months, we worked on the framework and it was finalized. And we have been running this framework for about 1.5 years now. The other question we had to address our minds to was whether Bank Pembangunan, BPMB, would turn away projects that do not meet a minimum score under the framework. Again, this was an intense discussion among various stakeholders internally, but we finally decided not to turn away projects that did not meet or achieve a minimum score for a variety of reasons. First and foremost, we understood that the bank itself, BPMB, needed time to understand how the framework was going to help us make decisions, number one. Number two, we also knew that many of our prospective customers probably would need time to understand what our expectations are or would be from a sustainability perspective. So in some cases, the projects we evaluated achieved a very good score. In other cases, the projects we evaluated didn't achieve such good scores, but it allowed us to make informed decisions nevertheless. And if a project was only able to achieve a score that perhaps was not in line with our general expectations, it would still give us the opportunity to impose certain conditions that perhaps would compel the project sponsor to put in measures that would help improve the score over time. So it was more an approach of guiding our customers to conduct their business operations in a more sustainable fashion, not immediately perhaps, but over time. Rolling out this impact assessment framework, it was not just a case of educating our customers, it was also a case of educating ourselves, educating the bankers within BPMB, because the bankers have been used to evaluating transactions in a particular way. So this new mindset is not simply a case of educating our customers, but also a case of educating the people who originate, evaluate, and present credit papers. So I was very mindful of that when rolling out the impact assessment framework. So the 1.5 years that this framework has been running was also an opportunity for the bank itself to learn what it really means to evaluate projects from an impact perspective.
BPMB has transformed itself from being a provider of development finance to a catalyst for a new economy. In its expansion efforts beyond the early developmental stage, it has shifted its focus to sustainability, digitization, and technology. BPMB has embarked on its 3-year strategic transformation plan 2020 to 2022 with the objective of supporting Malaysia's emerging development needs.
One key challenge, of course, was convincing some of our existing customers whose exposures currently conventional. Some customers were quite happy to go through the process of converting their conventional financing to Islamic, with, of course, the support from us. But others were somewhat hesitant for a variety of reasons. Some didn't see the commercial need for them to go through the conversion exercise. And of course, we couldn't compel them. Others gave the excuse that their financing facilities would mature within a year or 2 years, and therefore they would rather leave it as it is instead of going through the whole conversion process. On the liability side, we have actually taken on perspective that notwithstanding the penalties that might be payable when we convert our conventional liabilities, we would nevertheless undertake those conversions so that when our portfolio is 100% Sharia compliant, we won't have to worry about some of our liabilities still being conventional. So we redeemed 2 conventional exposures last year, and those redemptions came with hefty penalties, but these were penalties we were prepared to incur. And earlier this year, we redeemed another conventional loan, which also came with a penalty, which again, we were prepared to pay as part of the process to become a full-fledged Islamic DFI. The expectation is that 100% of our portfolio should be Sharia compliant before we can formally apply to be classified as a Sharia compliant DFI. So we are still only at about 80% at this stage. So that's why if we keep focusing on the 100% number, it might sort of distract us from the more practical issues of actually supporting projects that will have developmental impact to the nation. So that is now our focus, notwithstanding the fact that we still have a bit more work to do in terms of converting the entire portfolio to Islamic, it doesn't mean that we cannot continue playing our role as an Islamic DFI, as I said earlier, because all our financing going forward is Sharia compliant.
Organizations' understanding of sustainability has evolved over a period of 50 years to developing new management models which integrate sustainability. As such, consideration of issues relating to the impact generated by a company on people, planet, and economic prosperity should be ingrained in daily decisions. Transparency should be strongly applied in the company's commitment to broader sustainability goals being pursued at national or supranational levels, such as net zero pledges.
Firstly, obviously in the context of the pandemic and what we have done to support our customers in the context of the pandemic, because that's been a major issue for all financial institutions in the country. The authorities last year instructed banks to provide support to individual clients and SME clients, support in the form of moratoriums. In our case, we don't serve individual clients. We don't serve, well, by and large, we don't serve SMEs because the projects we finance tend to be the bigger projects in the economy. So that directive from the government did not directly apply to BPMB. So we were not under any obligation to grant moratoriums to our customers who are not individuals and who are, by and large, not even SMEs. However, we understood that just because a customer is not an individual or an SME, it does not mean that the business had not been impacted by the pandemic. So we took, again, a very practical approach to assessing whether customers should be granted moratoriums or not. We proactively looked at our portfolio and categorized the sort of portfolio into businesses that would definitely be impacted by the pandemic and businesses that might be less impacted by the pandemic. I'll give you a very simple example. We fund many hotels because we have what is known as the Tourism Infrastructure Development Fund. And the objective of this financing scheme is to help entrepreneurs establish hotels in Malaysia in line with the government's objective for Malaysia to become a tourist destination. So in order for the country to be an attractive tourist destination, we must have high quality tourism infrastructure. So we have funded many hotels. And when the pandemic hit, the hotels were very badly affected. We practically granted automatic moratoriums to our hotel customers because the last thing we wanted was for Bank Pembangunan, BPMB, to be an additional problem for our customers during this pandemic. So the initial moratorium was for 6 months, and then depending on the circumstances, we readily granted extensions of moratoriums. And in some cases, the moratoriums have extended beyond 1 year. Our priority is to help our customers weather the pandemic because we are confident that once things return to normal, inshallah, they will be able to turn around and they will then be able to pay whatever is due to BPMB. But right now, what they need is our support, and our support at this point in time is by way of granting them payment flexibility.
Thank you for watching. If you've enjoyed this video, please hit the subscribe button and click on the bell icon to get notifications on our new video. Do also follow IslamicMarkets.com on Telegram, LinkedIn and Twitter. You'll find the links in the description below.